Good afternoon. This is Tom Aspray with the Viper Report. It's Sunday, March 24th. This hourly chart pretty much sums up kind of a crazy week in the markets. Stocks based on the S&P were up like 0.37% on Monday, down slightly on Tuesday as they opened strong and closed weak. Selling continued early Wednesday until the FOMC meeting. We got a pretty sharp rally initially and then a sharp sell-off into the close. That looked pretty negative on a closing basis. Of course, the market likes to prove the majority wrong, and it rallied powerfully for all of Thursday, closing near the highs. But Friday was a different story. Thursday, we were up over 1%. Friday, we were down 1.9% to close on the week's lows. And you can see volume was pretty heavy in the last hour. In my weekend article on Forbes.com, The Week Ahead, New Technical Warnings, I discussed the market action in more detail. You can see from this table that it was kind of a crazy week. Dow up 1.3, NASDAQ up actually. Small caps got hit again, as did the transports, down 2.5, while the S&P lost 0.77%. Utility average was up 0.63. We're still along the XLU for the Viper ETF report, and they issued a new dividend last week. After last week's action, there are some more negative technical readings that one needs to be aware of. Divergence analysis plays an important role in both traders and investors' outlook for the markets. A number of my long-term students have made some great gains by spotting longer-term bullish divergences and negative divergences in key stocks and ETF, allowing them to get out near the highs or in near the lows. This chart of the NYSE Composite shows that we made new highs last week. The NYSE All-AD line did make a new high last week and is still above support and its moving average. The NYSE Stocks Only AD line shows a much different picture. It formed lower highs, as line C, and has now dropped below support at its moving average. A violation of line D would be even more negative. Also in this week's article, I feature this very interesting chart of the yield curve and how it impacts the economy. Of course, the Friday sell-off was due in part to the inversion of the yield curve. This goes back to 1960, showing how the inversion preceded all of the past 7 recessions. This chart, there's a link in the article, will show you how you can track it month by month. September 8, October, it was at 21, 22, but by March, January, it was 33%. That was as the recession started. It gave you a warning about a year plus in advance. Currently, we're only at 13, but if this inversion continues, it'll be something to watch before the next recession starts. As was the case in the last recession, I plan to be out of stocks and into either higher yield-bearing instruments or short the market before the next bear market. But we'll keep an eye on our recession indicators for the next year. If you'd like specific buy and sell advice on either ETFs or stocks, I hope you'll consider either the Viper ETF or the Viper Hot Stocks Report. You can find the sign-up pages on viperreport.com and hope you'll decide to join us. Should be an interesting week with the release of the Mueller report. Hard to figure out how that may impact the markets, but I imagine it will be interesting. Hope you have a great week. Thank you.